Today, ladies and gentlemen, the 5 finance management tools that keep the rich rich and you broke that you can start implementing today that have even taken me to a 6-figure dividend stock portfolio. So let's jump right into this. Welcome back, my passive income investors alike. These 5 rules I'm about to teach you today will change your financial outcome in your future. And it all starts simply with financial management. And this is some stuff that even Dave Ramsey, I don't think, talks about enough. And these are the personal tools I've implemented that have taken me to a 6-figure stock portfolio. And I think it's something that a lot of us need to kind of remind ourselves of constantly. And when I lose track of these, I find my finances even start slipping. So we'll start with the first and most important rule of anything you're ever going to do, guys. And I'm sure you've heard this by everybody, but it's just as simple as writing it down. If you want to become successful in anything you're doing, you got to write it down. You got to plan it out. And I take this to way too much of an extent as you look at my own personal income charts here. I document where I want to go, exactly what I'm making on income, what my expenses are, and how much I'm putting in my pocket at the end of the day. This tool alone can save you so much headache into the future. And if you have problems doing this, you can open up something as simple as a QuickBook app. There's a lot of different finance tools now on even Apple Pay that allow you to track and monitor all of your expenses, all of your income, and where it is going exactly. Because until you can see what it's doing, it's going to be out of your mind. Have you ever heard the saying, out of sight, out of mind? As a full-time magician, that saying holds more true in finance than anywhere else. So you need to start documenting your income before you do anything. Forget what Dave Ramsey's saying. Don't forget what they're saying, but just start focusing on paying attention first. As soon as you start paying attention, you'll start noticing things you've never noticed before. And if I lose track of writing things down or not paying attention to them, I notice I start spending money frivolously. I'll start noticing I start slipping on certain things. So make sure you always take your time to write it down. And if you're too lazy to write it down, make sure you get an app. And I am not here to promote these apps. I just know people that use them quite successfully. Now, if you've already taken the time to write down your finances, you know exactly what's going on. Well, you're one step ahead of the game. But the next and most important thing is are you protected against any downwinds or downfalls? Now, depending on how old you are and what situation you're in, basically making an emergency fund, building up protection, which is we're going to say is number 2, which is also one of I'm going to mention Dave Ramsey a lot here.
There's a reason to do the stuff we teach here.
But protecting yourself against any unforeseen events, car repairs, if you hurt yourself, if you need time off work, you always need to have some kind of a fund built up. Now, you don't have to do this in the traditional way of building up, 3 to 6 months of expenses like a lot of people say. If you are young like me, which chances are if you're watching this channel you are, I would not even recommend building up a $5,000 or $10,000 emergency fund. Instead, what I would do is try and direct that into a tax-free savings account and start building some positions in stocks or finding some investment tool that you can do where you can still have liquidity to your assets. So with stocks, at least you can sell them when you need them, but you can use the dividend income or try and find some growth in a company like Apple. Whereas if you do need access to that money in an emergency, it's easily accessible, but at the same time, it's not rotting away at a bank account, only making you 1 or 2%. Now, if you are a little older, a little farther along in your career, maybe you have some money saved up already, maybe you're starting to save up some money, it's more important that in a later age, you don't want to take on the risk of the asset dropping 20 or 30% plus. So instead, what you should do is actually build up some form of a security fund, an emergency fund to protect yourself against any oncoming things that may happen, because let's be real, shit happens in life, bro. Things just are going to hit you out of the side blinds. Birds are going to come flying into your car. You're going to swerve out, hit the ditch. I don't know what's going to happen, but there are always unforeseen expenses that come up that you need to be prepared for. But if you are younger, you can use an investment portfolio as an emergency fund. And heck, that's what I'm even doing. I leave a very small amount of money in my bank account to cover basic expenses for a few months. But at the same time, I know that if I need income, I can tap into my dividend stock portfolio, which you guys can check out here on my channel on a weekly basis to see how that performs. Because that way, if I'm not making a lot of money in a month, at least I know my stock portfolio is dripping some income. Listen to step 3. Now, step 3 is the one you're going to hear about the most from everybody, which is just essentially, guys, stop spending money on needless crap. So save your money. Now, I'm not even saying save it, but just don't expense it into things like cars, a lot of vacations. In fact, what you're going to do is, now that you're starting to manage your finances, you're paying attention to them, you have a little bit of protection money built up, you kind of worked a little bit, you saved up a couple grand, and now you're really ready to start hammering things. What you might want to do, and what a lot of people do, is they take envelopes and they write down exactly the percentage of their income that's going to go into that envelope for fun money, work money, food money, expenses, rent, all of that. And that is the money that you dedicate toward buying fun things. But honestly, if you're only making $40,000 a year and your car costs $40,000, you're not doing this right. The idea here, guys, is most people, where they lose out on financial management is simply by buying things that they think they need because somebody told them they needed it. And usually 90% of people go out and buy a brand new car, but they're only making $20,000, $30,000, $40,000 a year. You are not in a position to be buying a $30,000 or $40,000 vehicle unless you're making six figures. Your car shouldn't cost you half as much of your yearly income. In fact, my rule of thumb is your car shouldn't cost any more than a quarter of your yearly income. So if you need to buy a used car, I have never, ever have bought a brand new vehicle in my entire life. I have driven through 5 or 6 vehicles, as I drive a lot in my career, and vehicles are a high expense for me. And the reason you're probably justifying buying a vehicle to yourself is you're saying, well, you're going through a lot of vehicles anyways, so what's the difference if I buy a new one? I mean, you're still spending all that money driving and all this stuff, and instead at least I get the warranty and all these pretty flashy things. The thing is the cost of equity. Now, your vehicle has an asset value to it. I needed to tow stuff, drive around the city a lot, and I needed a car that could handle that, so I bought a Dodge Charger. I bought it used. It had 100,000 kilometers on it, and I bought it for basically $10,000, almost even. That car today, after putting another 100,000 kilometers on it, has dropped in value to $7,000. So I put 100K on it. I lost 3 or 4 grand if I were to sell it today. Pretty wild. Now let's go look at, say, a brand new vehicle for $40,000. Well, not only are you going to pay an insane tax on that, the second you drive it off the lot, you already lose 10 to 15% of the value of that vehicle. So say buy it at $5,000 or $10,000 the second you drive it off the lot. Then on top of that, every single year you're driving it, depending on how many kilometers you're putting on it, you're losing more and more on the base asset value. The worst investment you can make, I'm sure you've heard, is a vehicle. You don't need to look cool to get from point A to point B. It's just how it is, guys. So don't be going out and spending all this money on new vehicles, because car expenses are endless. Endless. My car costs me $500 to $600 a month and I own it. That is how much I drive. That is including repairs, oil changes, gas, and insurance. It's just insane. If you did not have that car payment, you would be a millionaire using compound interest. Which leads me into number 4. Start saving your money. Don't be buying frivolous shit. Save that money, guys. You got to start putting that money away. You got to start investing it. You got to start understanding exactly what compound interest is, how to make proper diversified investment decisions to protect yourself and grow your money into the future. I'm sure you've heard of a compound calculator. Well, if you haven't, I'm going to show you right now exactly what a compound calculator is and how it works. Essentially, if we just throw in some numbers here, let's say you have car payments that are around $500 or $600 a month. Let's just make it an even $500 a month. Say you started with $0 today, that $500 a month for the next 10 years. Let's see exactly how much it cost me just by plugging it in here. If I were to put it into a basic investment like an S&P 500 index fund, if you don't know what that is, it's basically taking the 500 largest companies, they all put them into a fund that's managed, and you just buy into that fund, giving you exposure to all those companies that has historically basically outperformed everybody. It is the benchmark for any financial investor, and we can see, guys, that it basically averages an 8% return after inflation. And with that 8% return, guys, we plug that into the calculator with $500 a month we're pissing away in our vehicle, it actually starts equating to an absurd amount of money. And heck, let's just keep pushing it farther. Why 10 years? Let's go into 20 years. Say if we were able to put that $500 away for 20 years without touching it at an 8% return. Now, you can actually beat these rates of return, and I have personally in the past, and you just have to kind of buckle down and keep saving and making the right investments, which isn't always easy and requires a little bit of luck. But even if you fall short and you only make, say, 5 to 8%, you're still going to be looking way better off. So you really need to start saving your income. Most investors try and save, or anybody in the financial independence retire early journey, the FIRE journey I'm sure you've heard about on YouTube here. Any of these people are trying to put anywhere from 30 to 50% away of their income. I'm personally, right now, this year, I think I'm averaging about 20 to 30% of my income I have put away. Last year, I was managing about 50% of my income I was putting away. And going into next year, I'm going to try and manage my wealth in a way where I'm back up to putting at least 50% away, because this is going to accelerate your growth so you can retire in your 40s, maybe even in your 30s. Which leads me into number 5, which I obviously been talking about for the last few steps, which is finding a way to produce more income, save money, and invest it. So basically, you started writing your finances down, you started paying attention to your finances, you found a way to protect your finances, you built up a little bit of an emergency fund, you got yourself protected against any headwinds that might come up. You stop buying stupid crap, you start realizing after writing things down, you're spending too much money on your car, on going out, eating out, whatever it is you're doing that you can cut down on. And a lot of people are kind of against this, like not going to Starbucks. But honestly, guys, if you're in a position where you want to actually have a financial independent future, you really got to start paying attention and being a little more frugal. It's quite simple, guys. If you're making here and you're trying to live like this, you're not going to get too far. You need to live here and live like a minimalist if you want to join the FIRE journey, essentially. But anyways, you started cutting down on those expenses, guys. You started realizing going to Starbucks and drinking a coffee every day is getting a little too expensive. So maybe you should only have Starbucks twice a week instead of 6 days a week. I'm just saying, guys, not trying to pat her down on your Starbucks there. And then finally, you've got your expenses cut. You found a way to get your savings up, and you finally started saving, 20, 30% of your income just to start pressuring yourself into your financial independence, retire early journey. The last thing you have to do is start finding ways to build your income and start investing that money. And it does not have to just be in the stock market, but you do need to start learning to invest. Once you start learning to invest, you pretty much hit the last peak of financial management, which means you've gotten everything else in order. You paid your debts off, which I'm not mentioning on here because Dave Ramsey talks about this enough.
The borrower is slave to the lender. If you didn't have any payments, you could build wealth, couldn't you? How fast would you be a millionaire if you didn't have any payments? Put your house payment in a calculator as an investment instead of a payment. How fast would that turn into $1 million? I'll help you with that. 8 years.
If you have debts, you need to pay attention to all of this, and that comes back to basically saving on your stupid expensive and cutting out all of your debt first. If you have debt, you need to focus on cramming that out of your life as soon as possible. I have, I think like $27,000 in credit available to me, and guess how much I owe? Absolutely zero. In fact, my credit cards pay me to use them because I top them up with my own money. And as I spend my own money on my credit card, I get about 2% back on my purchases. So every year, my credit card actually makes me a couple $100. I do not recommend that for everybody because the more important thing is making sure when you use your credit, you're able to pay it off in the first place. But once you've got your debts out of your way, guys, the most important thing you're going to do in your life is invest. And that could be a lot of different things. Investing in your education, investing in basically taking a part-time job, investing into the stock market, buying individual businesses, working on online businesses, maybe starting to do an Airbnb, looking into real estate and investment properties. There are many avenues that work differently for everybody. Heck, in fact, I know a guy that trades cars for a living. He won't even touch the stock market because he would rather go out and buy a used car and flip it because he makes a crazy rate of return just flipping cars. I mean, it doesn't matter what works for you, but you need to find a way to start investing into a side hustle or some other form of what I would call passive income is my personal favorite because that way you can still work at your job, but while you're sitting at home sleeping, at least you're still having an income. I do this personally with the stock market, and I'm trying to find other avenues, including this YouTube channel, to help create passive income and cash flow sources. And that is basically what comes down to financial management. If you can get all of these things in order, guys, and just repeat, rinse, and recycle, you're going to be crushing this game. Heck, when I was 19, guys, I was $20,000 in debt. It took me quite a few years to pay that off. But once I paid it off and I learned how hard it is to pay debt off, I started doing financial management. I started paying attention to my income. I started saving my money, and I started living as frugally as possible to find a way to become financial independent. Somewhere, hopefully, in my mid to late 30s is the goal. And if you guys stick around, you can consider subscribing and liking this channel if you learned anything cool today, and follow my own personal FIRE, Financial Independence Retire Early journey, my passive income investor journey here on my YouTube channel, guys. So I hope you learned something here today. This has been an interesting video for me to break down for you. Just something quick. It's a bit of a generalist video to help out somebody that might be new to investing, or maybe if you're really even a little experienced, hopefully you learned something today, guys. So stay cool, stay awesome. I look forward to chatting to you real soon.